Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
Hey, America. Welcome back to another round of Sound Retirement Radio. So glad to have you tune in into this episode. Before we get started, I like to start the day by renewing our mind, and I've got a verse here for us from Philippians chapter 4, verse 8. Finally, brothers and sisters, whatever is true, whatever is noble, whatever is right, whatever is pure, whatever is lovely, whatever is admirable, if anything is excellent or praiseworthy, think about such things. I'm so good at sleeping, I can do it with my eyes closed. In chapter 8 of my book, we dive into investing strategies, and I spend the first couple of pages of this chapter talking about diversification of your money across time segments, which is often called buckets. Since the publication of this book, I've completed some additional backtesting of a bucket strategy using a bucket simulator that one of our RBC community members developed, and which you also have access to. One of the things I was attempting to do in the buckets backtest was to simplify buckets by spending them sequentially rather than having refill rules. In this chapter, I discuss bucket refills, but after doing additional research on spending sequentially, I don't think the refill rules are necessary. I created a video, and I'll walk you through this, and I'll include a link to it in the show notes. And when you watch the video, you're going to see that this approach of diversification works very well when compared with a 60% stock, 40% bond mix that's rebalanced every year. At least it works really well in the context of history. As I often remind people that we serve, history is a guide, but past performance is no guarantee of future results. If you're interested in watching the video, I'll include a link at soundretirementplanning.com so that you can see how the bucket strategy performed. And I will also provide some links so that you can do your own bucket backtesting. After the discussion on buckets, I get into the art and science of investing, and we discuss both strategic asset allocation as well as tactical investment money management. And next week in Chapter 9, I'm going to go into more detail about why asset allocation is so important. When you become a premium member of the retirementbudgetcalculator.com, you gain access to our private community portal. Within the community, we have checklists and flow charts to help you with your retirement planning. We also have a lot of smart, attractive, athletic, funny people who are willing to share their best tips, tricks, and ideas when it comes to all things retirement. If you haven't joined us yet, visit retirementbudgetcalculator.com and sign up for free. Make sure you like it. And if you do, subscribe. Chapter 8, Investing. Buckets of Money, an investment strategy for retirement planning. During your career years, figuring out how to fund your lifestyle isn't too difficult. As long as you spend less than you earn, you're doing pretty good. After decades of diligent saving and investing, new retirees face a new challenge: how to fund their lifestyle when their monthly income doesn't cover their expenses. The bucket strategy is one investment framework designed to help answer that conundrum. This strategy breaks out investment strategies based on different time horizons. It provides for immediate financial needs while optimizing part of the portfolio for long-term growth. Here's what you need to know about it. What is the bucket strategy? As explained in the last chapter, the bucket strategy is a retirement framework that allows people to group investments based on timing. It helps retirees balance risk and reward over a longer time horizon, like a 30-year retirement window. Given the low-yield bond environment and the slow disappearance of private pensions, the bucket strategy can make a lot of sense for retirees. Now, as a note, I wrote this before 2022 when interest rates shot way up. One of the things that I think has happened recently is that people that are retiring today in 2023 have a much better safety net established within their fixed income than they did when interest rates were almost at 0%. So that's a good thing if you're getting ready to retire in the future. Okay, back to the book. It can help retirees decide how much they can risk for growth and how much money needs to be accessible. Even better, retirees can use this strategy to create a retirement paycheck. This monthly paycheck can be used to fund gaps in your retirement budget. A simple version of the bucket strategy divides a retiree's financial assets into two buckets: the cash bucket, would have money available in cash savings, things like savings accounts, CDs, or money market funds for short-term needs. And the investment bucket includes investments such as stocks, bonds, and real estate. In this very simplified strategy, a retiree can sell some of the investments or take income from the investments to fill the cash bucket. The retiree then can create a retirement paycheck by transferring cash into a checking account each month. The bucket strategy offers several advantages for retirees. First, the large cash cushion allows a retiree to continue living their intended lifestyle even during a market downturn. Second, dividing assets into buckets allows a retiree to accept more volatility in their investment bucket, and this can lead to higher growth prospects in the long run. Recommended buckets. Of course, simply knowing about two labels doesn't offer much guidance to retirees. Retirees and aspiring retirees can read up on the various ways to implement the strategy, but for simplicity, the retirement budget calculator displays a 4-bucket strategy. These are the 4 buckets. Bucket number 1 is called income, also cash. This is the money that you need in the short term, usually 1 to 4 years. Imagine a retiree with an annual spending of $50,000 per year. This person receives $35,000 from Social Security and other guaranteed income sources, which leaves a gap of $15,000 per year. The income bucket would need to hold $15,000 to $60,000 in cash. The money should be accessible but not subject to risk. For example, it might be held in a money market fund or high-yield bank account. While it can feel good to have a large cash cushion, you don't want to overemphasize this bucket. Having too much cash can drag down portfolio performance. Money in the cash bucket should be separated from your primary checking account because cash in the primary checking account tends to be too easy to spend. Instead, retirees can set up automatic monthly transfers from the cash account into their checking account. This allows them to mimic the monthly paychecks that they earn during their career. The conservative bucket is going to be the second bucket you're going to spend, and it's going to hold the amount of spending that you need for years 4 through 6. While it should be invested, its primary goal is to match inflation. Usually high-quality government bonds or CDs would be appropriate for this bucket. A short-term or intermediate-term bond fund would work too. Given the low yield environment, this bucket may just match inflation and may even underperform inflation slightly. However, in most cases, it will perform better than the cash bucket and the assets should be fairly stable. The next bucket is what we call the intermediate bucket. In the intermediate bucket, retirees may want to take a bit more risk. This could be the right bucket for a mix of high-quality bonds and perhaps some equities depending on your willingness to accept volatility. The growth bucket is the final bucket. And the goal of this bucket is to produce long-term growth for your investment portfolio. Even if you're retired, a large portion of your assets should be poised for growth. This is the money that you're not going to need for a decade or more. Most of the money should be invested in growth assets like stocks. This portion of your portfolio should ideally have both domestic and international exposure. Stock mutual funds or low-cost index funds could both fit well in this bucket. Preferred stock or higher risk bonds may also fit in this bucket depending on your investment preferences. How to fill your buckets during retirement. During retirement, you'll need to do some bucket maintenance. It would not make sense to spend all of your conservative assets during the early years of retirement. Instead, retirees will want to refill the cash bucket using assets from other buckets. Refilling buckets does not require rigid rule following or careful attention to the financial markets. Instead, a quick portfolio review a few times a year should be enough for a retiree to decide how to refill the buckets. The exact refilling strategy can depend on market performance from the previous year or two. Since retirees start with enough cash to cover a few years of expenses, they should never be forced to sell assets that are in the dumps. To refill the cash bucket, retirees first want to look at income, dividends or yield from all the buckets. If the income isn't sufficient to cover the full cash refill, investors may need to sell some portion of their assets to cover the gap. When stocks do well, selling some of the stocks from the growth bucket is preferable. During a good year, the stock portfolio will continue to have a very high value, even after the retiree sells some shares. Of course, if stocks perform poorly, selling shares doesn't make sense. In that case, retirees may want to sell some of the bond assets from the conservative or moderate buckets. When neither bonds nor stocks do well, retirees can hold off on rebalancing for a year or two. After all, the first bucket starts with enough cash to cover 2 or 3 years of spending. After a few years, it's likely that some part of the portfolio has recovered enough that retirees don't have to sell assets when the assets are at low prices. After all, the mantra is buy low, sell high, and that still applies during retirement. Remember, every retirement investment strategy starts with your budget. It starts with understanding your spending. The bucket strategy is one useful framework for managing your investment portfolio during retirement. But this strategy, along with most other investing frameworks, require you to know your budget. The retirement budget calculator can help you understand your cash flow needs in a detailed way. It forces you to look in detail at your major budget categories so you can successfully plan your total needs. When you know and control your cash flow during retirement, any investing framework you choose is more likely to be a success. The art and science of investing. Alan Greenspan once said, "The stock market's a funny place. When one person sells, another person buys, and they both think they're right." As we continue to look into academic research about investing, it's important to consider that the research is ever evolving. As a result, our understanding and application is also evolving. Dimensional Fund Advisors has been at the forefront of taking academic research and creating mutual funds and exchange-traded funds that investors can use in their investment asset allocation. Vanguard has been a driver of market capitalization-weighted indexing and the driving force for bringing down fees for the average investor. Dimensional and Vanguard are two companies worth learning more about. At the end of the day, the name of the investing game is higher expected returns for a given level of risk. It's important to consider the sources that you're using for investment advice. Are you taking investment advice from Main Street, Wall Street, or academia? Advice from Main Street would be the equivalent of listening to your friends, coworkers, or family members who mean well, but they may not have spent the time to give appropriate advice for your specific situation. Wall Street advice is what I consider coming from brokerages, banks, and insurance companies, and it can be tainted because there is often a sales motive, and it can be hard to sort the research from the sales pitch. Academia, on the other hand, has a different motive. Academics are paid to research and teach. They have a different motive than Main Street or Wall Street. We are all gathering information all the time to help us understand how to optimize our investing strategy. This area of financial science from the academic community is always evolving, and as we gather the information, we must decide who's a trustworthy source of information that we're going to use to make important decisions. If you must choose between these three sources of information, I'd recommend you start with the academic research. Two different philosophies can be combined for how you invest your money in the stock market. Tactical investment money management, which I call the art of investing, and strategic asset allocation, which I call the science of investing, are those philosophies. And we're going to take a look at each of those below. I believe that both of these styles can be good for different reasons. I tell our clients tactical and strategic investment styles serve a purpose, and depending on market conditions and your goals, different strategies may be better suited than others. Tactical investing. In tactical or active investment money management, the managers are seeking opportunities and looking to avoid risk by actively trading and managing a portfolio. This style of management, the art side of investing, can't be academically or scientifically proven, but some managers have had very impressive results over a long period. Even though there's no guarantee that exists that these results will continue, you would be hard-pressed to discount what some of these tactical money managers have achieved. The reason you would consider tactical investing in your retirement is to attempt to reduce volatility for a segment of your investment strategy. Strategic investing. Strategic asset allocation was born through modern portfolio theory. Harry Merkowitz won the Nobel Prize in 1990 for developing this theory. And then William Sharpe won the Nobel Prize the same year for his contribution to the capital asset pricing model, which we'll talk about soon. Then, in October 2013, a man named Eugene Fama won the Nobel Prize for the efficient market hypothesis. The efficient market hypothesis asserts how the financial markets are informationally efficient, and one cannot consistently predict returns in excess of average market returns. Here's a quote by Jack Bogle, the founder of Vanguard. He said, "Investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes." The modern portfolio theory proposes how rational investors use diversification to optimize their portfolios and decide how a risk asset should be priced. Modern portfolio theory assumes that investors are risk averse, meaning that given two assets that offer the same expected return, investors will prefer the less risky one. Thus, an investor is only going to take on increased risk if compensated by higher expected returns. Conversely, an investor who wants higher returns must accept more risk. The precise trade-off will differ depending on the investor's individual risk aversion characteristics. The conclusion is that a reasonable investor would not put money into a portfolio if another one with a better risk-return profile already exists. If an alternative portfolio with a better anticipated return exists for that level of risk, the rational investor will select it. A landmark study by Brinson, Hood, and Biebauer, often called the BHB study, that was conducted in 1986 and then updated in 1991 and expanded in 1993, suggests that portfolio asset allocation is the most important long-term determinant of investment results. Strategic asset allocation also suggests that no one can accurately and consistently predict when shifts in the market leadership will occur or how long they will last. The market leaders of one year are often the laggards the next. Strategic asset allocation therefore suggests that it's important to spread your assets across multiple investment asset classes and sectors as you potentially benefit from an upswing in any one asset class. It also suggests that the stock market's efficient and that all asset classes do not usually move in tandem. We're hoping that when one asset class zigs, the other zags because we're searching for a balance between these asset classes. Rebalancing inside of strategic asset allocation. Have you ever heard that the secret to success in the stock market is to buy low and sell high? Unfortunately, many studies point out that individual investors are fairly bad at timing the stock market. And these studies suggest that most people tend to invest after a long and sustained bull market, and then they sell after the market has crashed. Essentially, they're buying high and selling low. What if a way existed to strategically buy low and sell high? One of the ways I believe you can intelligently invest in the stock market is to create a broadly diversified portfolio across asset classes, sectors, and across the entire globe. This method of diversification is called strategic asset allocation and is built by using low-cost index mutual funds or exchange-traded funds, ETFs. A powerful ingredient that makes strategic asset allocation attractive is rebalancing the portfolio. Rebalancing is counterintuitive because it forces you to sell some of your winners and buy more of your losers. If you agree that the market's efficient, then you agree that no one asset class or sector will ever dominate from year to year, and that eventually a regression to the mean will occur. So while large cap growth may be the best asset class this year, perhaps small cap value will be the best next year and treasury inflation protected securities the next. Rebalancing is an intelligent, non-emotional way to buy low and sell high. How often you should rebalance your portfolio can and should be debated, especially depending on what stage of life you're in and the tax considerations of your portfolio. If you're in the accumulation mode versus the distribution mode, some people will rebalance a portfolio based on a calendar year of historical data. An old saying goes, sell in May and go away, but instead of selling, you could use this historical data to rebalance your portfolio in May. Depending on whether you have your money invested in a qualified or non-qualified account may impact how often you want to rebalance your portfolio from a tax planning standpoint. We set drift parameters for our strategic portfolios at anywhere from 2% to 5%. Anytime one asset class has drifted out of alignment by more than 2% or 5%, that's an indicator for us to rebalance a portfolio. Rebalancing as part of a strategic asset allocation is a calculated, non-emotional way of helping you buy low and sell high. Many academic articles have been written on modern portfolio theory, efficient market hypothesis, and the benefits of strategic asset allocation and rebalancing. Both strategic and tactical investment styles offer advantages and disadvantages. Market conditions will determine which one of these styles will perform the best. In an upward trending market like we had from 1980 through 1999, a strategic asset allocation will probably have performed best. In a very volatile market like we had in 2008 or March of 2020, tactical asset allocation may have performed better. Why include tactical positions? I want to address questions that many people have about active money management or tactical money management. Why would you want to include the tactical position and include what I call the art of investing? Aren't you going to pay more money in fees and expect a lower return? Keep in mind that investing in retirement is different from your accumulation years. When you're accumulating wealth, volatility is just noise. Let me say that again. When you're accumulating wealth, volatility is just noise. If anything, the volatility helps you. Hopefully, you're making regular contributions to your retirement accounts, and by doing so, you're dollar cost averaging those contributions. You're buying more shares at a lower price, and so volatility helps you accumulate wealth. However, the exact opposite happens in the distribution phase of your financial life. If you're selling shares to generate income while the market is falling in value, you are reverse dollar cost averaging. So then, why might you want to include a tactical position? The reason you would include it is to help you reduce volatility in the portfolio. You would not do it for lower fees, nor would you do it for higher expected returns. You would include tactical money management to help reduce volatility at a time where volatility is no longer noise, but real risk that could impact you negatively as you draw money out of your investments. Adding active money management is no guarantee that you're going to reduce volatility. You would want to review the long-term track record of any tactical managers before investing and make sure that you're willing to pay higher fees and accept the fact that there's probably going to be a lower performance for the expectation that there would be reduced volatility. If you have more than 5 years before retirement, you don't need to worry about adding tactical money management unless you tend to be more conservative. If you're in your 20s, 30s, and 40s, I would recommend that you just invest in a strategic asset allocation. In my years of experience, I've never had someone walk into my office and when I ask them the question, what's the purpose of their money? And they say, Jason, the purpose of my money is to beat the market or to beat an index. They've never even said the purpose of my money is to track an index. Most of the time, what they say is they just want their money to earn a fair rate of return, maybe a few points above inflation, and they don't want to worry about running out of money in retirement. Additionally, when things go really bad, they don't want to get wiped out in retirement. The other day, I read an article about people who were investing in leveraged funds. In a matter of weeks, they saw most of their wealth wiped out because they were playing a high-risk game, which is not the game that you want to play as you're starting to transition into retirement. As an advisor, I find that I spend a lot of time keeping our clients from investing in ways that they don't need to at this phase of their lives. Are there downsides to strategic asset allocation? Let's talk about some of the negatives associated with strategic asset allocation. Markowitz, who won the Nobel Prize in modern portfolio theory, said, "We're trying to minimize risk for a given return. So how do you do that?" He says the answer is to diversify. Don't put all of your eggs in one basket. William Sharpe, who I also referenced for winning the Nobel Prize for capital asset pricing model, explains that CAPM has to do with the price of a security, its risks, and its expected return. He says there are two key takeaways from capital asset pricing model. First, he says the most efficient strategy is to be broadly diversified. Second, he essentially tells us that there is the potential for greater reward for those who take greater risk. He says there will be a reward with higher expected returns for bearing the risk of doing badly in bad times. It's very important to understand that life is risky. It's so risky that none of us are going to get out of here alive. If you think you can create a strategy and not accept any risk, then you're going to have to accept that there's not going to be a significant return. There's a trade-off. Accepting that life is risky is just understanding that this is the world we live in, and that's a good thing. We get compensated for the risk we take. What most people have come to learn from all of this academic research is to use index funds for broad diversification, keep your fees low, and use a long-term strategy for accumulating wealth by following something like modern portfolio theory. But what about the next phase as you transition out of the wealth accumulation and into the distribution phase of investing? Let's revisit what our referenced Nobel Prize winners in economics have told us. We have all this academic theory around portfolio construction, but it was all based on the accumulation of assets while we're still working. After Markowitz won the Nobel Prize in economics, he was asked to contribute an article to a magazine called the Financial Services Review about the implications of modern portfolio theory for the individual investor. This was way back in 1991, which was 1 year after he had won the Nobel Prize for the same theory. In this article, he writes, "But an evening of reflection convinced me that there were clear differences in the central features of investments for institutions and investments for individuals." He goes on to say, As I thought about the subject further on subsequent days, I found myself of two minds. He says that when he wrote the dissertation that ultimately won him the Nobel Prize, the investing institution, which I had on my mind when developing portfolio theory for my dissertation, was the open-end investment company or mutual fund. Modern portfolio theory was based on investments for institutions, not necessarily for individuals. And Wade Pfau points out that the theory doesn't account for any need to take distributions from those investments. In Wade Pfau's book called Safety First Retirement Planning, he explains it this way. This is the key to understanding how retirement income problem differs from the modern portfolio theory approach. Households must meet spending needs over an unknown length of time in retirement. Modern portfolio theory just seeks to grow wealth over a single time period, such as a year when there's no need to take distributions from the portfolio. It's an assets-only model. In a model where distributions and time are not important, modern portfolio theory is a winning strategy. This is why it works so well for people who are in the accumulation years. However, it may not work as well when you're in the retirement phase of life, when you're pulling funds from your portfolio instead of accumulating funds. Modern portfolio theory and capital asset pricing model are all geared towards accumulating wealth. Oftentimes, I meet with people who have been using these strategies during their accumulation phase of life, and they've been very pleased. But the game changes in retirement. Now, time and distributions are factors that need to be considered. Managing volatility, standard deviation, sequence of returns, and cash flow from investments become the new goal. You're no longer in the wealth accumulation phase of life. When you retire, you want your money to continue to work, but it needs to work differently. We know that the future is unknown and unknowable. And the longer I work in the investment field, the more humility becomes an important virtue. Making decisions based on past performance is like driving your car and only looking in the rearview mirror. You might get where you're going, but I wouldn't want to be the passenger in the car. I like how Merkowitz thinks about financial planning. In that paper that he wrote back in 1991, he used the term the game of life model, where he says, time and uncertainty are the heart of the problem. If you think about it, the game of life model that he talks about creating is a computer program that would allow you to test your hypothesis. As we near or start retirement, we need a way to test which investment theory will work best for us. And that's why I built the retirement budget calculator. If you think you can retire, why not test your own game of life model and see if it's going to work? What can you do to create a guaranteed income stream? Now we can discuss William Sharpe. He also won the Nobel Prize back in 1990 for a capital asset pricing model. Not only is Sharpe a Nobel Prize winning economist, but he's also a professor of finance emeritus for Stanford University Graduate School of Business. In 2019, he was 85 years old and he was interviewed by Barron's. The resulting article is titled, How to Secure Lasting Retirement Income. And let me share with you a few quotes from this article. The most difficult problem in finance, says Sharpe, is knowing how to strike a balance between having enough income to meet your current needs and having enough to get you through your lifetime. He goes on to say, and this is a key for the accumulators that are trying to make this switch into the retirement and distribution phase. Over the course of my career, I have always been interested in individual investors. My early work focused on helping people accumulate money. Again, modern portfolio theory, efficient market hypothesis, capital asset pricing model, they're all geared towards this accumulation phase. The idea of broad diversification works well in a strategy where time and distributions aren't important. But then he says, if you invest your money in almost anything except in an annuity with a cost of living adjustment, you're going to be subject to two kinds of uncertainty, investment uncertainty and mortality uncertainty. And I like this. He goes on to say, and this is a quote from William Sharpe, when you retire, you make your initial decision on buying annuities, investing, and adopting some sort of spending plan. I would think it would make sense to sit down at least once at the outset with a financial advisor. One of the things that he knows is that if you can keep your fees low, you're going to do better. He adds, I don't necessarily advocate paying 1% of your fees to an advisor indefinitely. For some of you, it's a really good plan to hire an advisor and pay 1% per year in fees. On the other hand, some of you are well equipped. This is an area where you spend a lot of time and paying the 1% fee may not make sense. And for someone like Sharpe, who has spent his whole life in the field of finance and investing, It may not make sense for him, but the one point I would argue is that for many of you, this is not how you spend all of your time, nor is it where you want to spend all of your time. You've done a really good job in terms of accumulating money because you've been a good saver. You've kept your spending low, but paying a fee to get the advice makes sense for you. And so if that's the case, some things are worth outsourcing. And we'll look at hiring an advisor and the costs and the benefits of doing so in a future chapter. Let's take a look at another quote from this article in Barron's. William Sharpe says, "We who have been on the investment side have been babbling about pooling investment risk all of our lives. Diversify, diversify, diversify. And yet when we retire, longevity risk is at least as big a risk as investment risk. And you really should consider pooling some of that, particularly as you get into the later stages of retirement." Now, when he's talking about pooling longevity risk and mortality risk, he's talking about considering buying an annuity to create a floor of guaranteed income for some basic level of spending. Still, referencing this article from that 2019, the interviewer says, "Your ebook outlines a strategy that you call a lockbox. Can you take us through it?" And to this, Sharpe responds, "The idea is that you want to segment your money. It's similar to using buckets, but with a time component. One of the things I've been preaching for years now is that time is the cure to the volatility of the stock market. The more time you have, the more risk you can afford to take. But what I love about Sharpe's work when it comes to time segmentation or bucketing, laddering your money over time, or lockboxes as he likes to call them, is listening to what he says next. He says, "The bottom line is that bucketing your assets in annual increments with different initial asset mixes in these lockboxes can provide a more efficient production of retirement income over time. In the retirement budget calculator, we show you how to diversify using time segments for your specific situation that is based on the gap between your guaranteed income and your projected spending." We've had guests on our podcast, Sound Retirement Planning, in the past that say that using buckets, well, it reduces your overall return by having different buckets. But Sharpe says it can provide more efficient production of retirement income over time. Remember, you have to ask yourself as you're making this transition into retirement, what's the purpose of the money? Are you still in the accumulation phase of life, or have you made the transition into the distribution phase? You've got to think differently about your money as you transition into retirement. A challenge that you will run into is that there are a large group of practitioner advisors who like and recommend buckets, and another segment of advisors who prefer to use a different withdrawal strategy, and they do not recommend the use of buckets. Ultimately, you will have to evaluate the information and decide what is best for you. So where does this leave us? Should you consider a tactical investment strategy as part of your plan to help reduce standard deviation or volatility? Yes, because the sequence of return risk is real. Now, it doesn't mean everybody's going to want to pay the higher fee, and that's okay, but should you consider it? Well, I think so. Should you include strategic asset allocation as part of your overall investment strategy? When you have time on your side, I would say so. Remember, modern portfolio theory, efficient market hypothesis, capital asset pricing models work great in an asset-only strategy. But now we're not talking about assets only. We're not talking about accumulation. We're talking about distribution. We're talking about a time when time matters. Should you use buckets, or as Sharpe calls them, lockboxes, to diversify your money across time as you head into retirement? Well, I think so. That's what I've been talking about for the last several years on Sound Retirement Radio. I would argue yes, and that's not just because I'm a financial advisor who walks life with real people that have been on this journey, but it's because this is what some of the academic community also recommends as a way of dealing with, as Sharpe says, the most difficult problem in finance. Should you consider purchasing an annuity with some of your retirement funds to provide a guaranteed income at some point in the future and as a way to de-risk as you head into retirement? Should you create an income floor? Do you need one? Well, I don't know, because I don't know your situation. Some of you already have a good floor. Sometimes the floor that Social Security creates for you is enough. But for some of you, you really should have an additional annuity income. Some of you have a pension, which is an annuity, and that creates the floor that you need. In the retirement budget calculator, we created the secure income score to determine how much of your essential expenses are covered by guaranteed income, and we made the benchmark 80%. If you have 80% of your essential expenses covered by guaranteed income, then you don't need to consider purchasing an annuity. Some of you don't have pensions or Social Security, and so you need to be thinking about taking some of your retirement assets and saying, how much do I need to annuitize to guaranteed income? An annuity is the only financial tool you can use the words guaranteed income. Of course, the guarantees are based on the financial strength of the company, but to guarantee at least a basic standard of living is wise. I heard somebody once call it his beer and pizza money. He says he doesn't want to gamble his beer and pizza money. I think maybe beer and pizza would fall under more discretionary spending, in my opinion, but you do want to be able to keep the lights on. You want to be able to pay the mortgage if you have one. You want to be able to buy food and groceries.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.